For years, aggressive growth was the strategy every major company chased: grow faster, hire faster, expand into more markets, launch more products, scale as quickly as possible. In corporate America, speed became everything. Companies were rewarded for expansion even when profits were weak. Investors poured money into businesses that could grow rapidly. Tech companies especially operated under one major assumption: dominate first, figure out efficiency later. And for a long time, that strategy worked. Cheap money flooded the economy, interest rates stayed low, investors tolerated losses, risk-taking was heavily rewarded. That environment pushed businesses to prioritize expansion above almost everything else. But now a major shift is happening inside corporate strategy. Aggressive growth is quietly being replaced by something very different: controlled resilience. And this new strategy is reshaping how businesses hire, spend, invest, and compete across America right now. Because companies are starting to realize something important: growing fast means very little if the business becomes unstable. The biggest reason for this shift is simple: the economic environment changed completely. For years, companies operated during one of the easiest expansion periods in modern business history. Borrowing money was cheap, funding was widely available, consumers were spending aggressively, expansion felt relatively safe. But today, conditions are much harder. Interest rates are higher, capital became more expensive, investors want stronger profits, consumers became less predictable, and uncertainty now affects almost every industry. That combination forced businesses to rethink their priorities. Instead of asking, "How fast can we grow?" companies are increasingly asking, "How stable can we become?" And that shift is changing corporate behavior everywhere. Businesses are hiring more carefully, cutting weaker projects faster, reducing unnecessary spending, and focusing heavily on efficiency instead of nonstop expansion. Even major tech companies that once celebrated aggressive scaling are becoming far more disciplined. A few years ago, businesses feared missing growth opportunities. Now many companies fear overextending themselves. That psychological change matters enormously, because uncertainty became one of the defining forces shaping the modern economy. Consumer behavior changes quickly. Global supply chains remain fragile, technology is disrupting industries rapidly, and economic conditions often feel unpredictable. That uncertainty makes aggressive expansion feel much riskier than before. So instead of building strategies around maximum growth, companies are increasingly building strategies around flexibility. Flexibility became one of the most valuable assets in business. Companies want the ability to adapt quickly if conditions suddenly change. That's why businesses are investing heavily in operational efficiency right now. Not just growth, efficiency. This is one reason layoffs became such a major trend across corporate America. Many businesses realized they expanded too aggressively during previous growth cycles. They hired too quickly, built oversized teams, expanded operations faster than demand could support. Now companies are trying to become leaner and more controlled, and artificial intelligence is accelerating this shift even further. AI allows businesses to increase productivity without hiring at the same pace as before. For years, growth usually required massive increases in staffing. Now companies increasingly believe they can scale revenue while keeping employee growth much smaller. That changes the relationship between expansion and labor completely. Businesses no longer automatically associate bigger workforces with better performance. In fact, many companies now view operational complexity as a major risk, and investors are rewarding that mindset. A few years ago, financial markets often rewarded businesses mainly for rapid user growth and expansion potential. Now investors increasingly care about profitability, cash flow, margins, and operational discipline. That changes executive decision-making dramatically, because public companies respond directly to what financial markets value, and today, predictability matters far more than reckless expansion. This is one reason recurring revenue models became so important. Subscriptions, memberships, long-term service contracts, ecosystem-based business models. Companies want predictable income because predictable income creates stability, and stability became one of the most valuable traits in modern corporate strategy. This is also why businesses are becoming more selective about customers. Instead of chasing endless growth, companies increasingly focus on retaining loyal, profitable customers over long periods of time. Retention matters more now than raw expansion. That changes how businesses market products, build services, and structure customer experiences. Another major shift involves expansion itself. For years, companies aggressively entered new markets as quickly as possible. Now businesses are becoming far more cautious. Instead of expanding everywhere at once, many companies are strengthening core operations first. Instead of launching endless new products, businesses are focusing on products with stable demand and reliable profits. Focus is replacing overexpansion, and some of the world's largest corporations are already moving in this direction. Many companies are simplifying operations, reducing complexity, consolidating divisions, and narrowing strategic priorities. Because rapid growth often creates hidden inefficiencies, the larger companies became, the harder operations became to manage efficiently. Now businesses want tighter control, and consumers are noticing the effects too. Free services are disappearing, discounts are becoming more selective, product launches slowed down, companies are becoming more careful with spending. That's because protecting margins became more important than chasing nonstop visibility. And there's another reason aggressive growth is losing favor. Many businesses discovered that rapid expansion can quietly weaken long-term stability. Fast growth often creates hidden problems, weak internal systems, overhiring, poor coordination, unsustainable costs, operational inefficiencies. Those weaknesses may stay hidden during strong economic periods, but when conditions become harder, those problems get exposed very quickly. That's why resilience is becoming the new corporate obsession. Resilience means building companies capable of surviving unstable environments, not just succeeding during easy ones. And this mindset is spreading into every part of business strategy, especially supply chains. For years, businesses optimized supply chains almost entirely around efficiency and low cost. Now companies increasingly prioritize reliability and redundancy. Many businesses are willing to sacrifice some efficiency if it improves long-term stability. Because recent disruptions exposed how fragile overly optimized systems can become. That same thinking is now reshaping corporate strategy more broadly. Businesses are planning for volatility instead of assuming smooth growth will continue forever. And that changes everything. Hiring becomes slower, expansion becomes more selective, investments become more targeted, spending becomes more disciplined. Even corporate culture is evolving. For years, business cultures celebrated nonstop ambition, move fast, disrupt industries, scale aggressively. Now many companies emphasize discipline, sustainability, efficiency, and operational control instead. The goal is no longer simply becoming bigger, the goal is becoming harder to destabilize. And that may be the new corporate strategy replacing aggressive growth across America right now. Not reckless expansion, not growth at all costs, but controlled, resilient, efficient growth designed to survive uncertainty. Because in today's economy, businesses increasingly understand something important. Growing fast may impress people temporarily, but building a company strong enough to survive instability is what truly matters long-term.